lovely students, welcome back my AR Business Academy YouTube channel. In this channel you will learn accounting, marketing and management as well. We want to enhance your skills and your future. Today's video we will explain about the principles of accounting and financial statement as well. Our learning objectives, introduction of accounting principles, explanation of financial and managerial accounting, explanation of accounting measurements, explanation of forms of business organization in accounting world. And we have a Telegram channel. You can subscribe it. Because we have homework for new learners in our Telegram channel. So let's start with principles of accounting. You can ask me one question: what is accounting? Accounting is an information system that measures, processes, and communicates financial information about the business. Accountants focus on the needs for financial information, whether the decision makers are inside or outside the business or another economic entity. Accountants supply the information decision makers need to make reasoned choices among alternative uses of scarce resources in the conduct of business and economic activities. So here we have accounting process. Now I'm gonna explain it. Firstly, accounting measures business activities by recording data about them for future. Secondly, the data are stored until need then processed to become useful information. Thirdly, the information is communicated through reports to decision makers. Finally, based on information from accounting, decision makers take an actions that affect subsequent business activities. In other words, data about business activities are the input to the accounting system, and also useful information for decision makers is the output. Let's move to the next slide. Next slide, we have types of accounting. These are financial and managerial accountings. An accounting's role of measuring, processing, and communicating financial information is usually divided into financial accounting and managerial accounting. Also, the functions of financial accounting and managerial accounting overlap. They can be distinguished by the principal users of their information. Let me explain what is financial accounting. Financial accounting is external decision makers. They are using financial accounting to evaluate how well the business has achieved its goals. These reports, called financial statements, are a central feature of accounting. Financial statements reports on a business financial performance and are used extensively both inside and outside the business to evaluate its financial success. It's important to distinguish accounting from bookkeeping and management information system like MIS. What is bookkeeping? What does it mean? Bookkeeping is the process of recording financial transactions and keeping financial records. It's mechanical and repetitive, yet an important part of accounting that is usually handled by computers. So, managerial accounting is internal decision makers. They are using information provided by managerial accounting about operating, investing, and financing activities. Managers and employees need information about how they have done in the past and what they can expect in the future. For example, GAP, you know, it's a retail clothing business store, needs an operating report that tells how much was sold at each store and what costs were incurred, and it needs the budget, the project, each store sales, and costs for the next year. The key term is Management Information System, MIS, consists of the interconnected subsystems, including accounting, that provide the information needed to run a business. So after this slide, we have accounting measurements. To make an accounting measurement, the accountant must answer four basic questions. What is measured? When should the measurement be made? What value should be placed on what is measured? How should what is measured be classified? Accountants debate the answers to these questions constantly, and the answers change as new knowledge and practice require. But the basis of today's accounting practice rests on several widely accepted concepts and conventions. We begin by focusing on the first question: what is measured? We discuss the other three questions in the next chapter. So, business transactions can be an exchange of value, like a purchase, sale, payment, collection, and etc., between two or more parties. A transaction also can be an economic event that doesn't involve an exchange. Some examples of non-exchange transactions are losses from fire, flood, explosion, and thefts. Physical wear and tear on machinery and equipment, and the day-by-day accumulation of interest to be recorded. A transaction must relate directly to a business entity. So we have money measure. What does it mean? All business transactions are recorded in terms of money. This concept is called money measure. Of course, non-financial information may also be recorded, but a business transactions and activities are measured through the recording of monetary amounts. Money is the only factor common to all business transactions, and thus it's the only unit of measure capable of producing financial data that can be compared. The monetary unit the business uses depends on the country in which the business resides. For example, in the United States, the basic unit of money is the dollar. In China, it's the yuan. In Japan, the yen. In the European Union, euro. And the United Kingdom, the pound. In international transaction, exchange rates must be used to translate from one currency to another to another. An exchange rate is the value of one currency in terms of another. Here you can see this table. The British pound is the price in US dollar $1.59. European is $1.32 and Russian ruble is 3 cents. Singapore 79 cents. Yes. We will continue about our topic accounting measurement. So accounting measurement has one term, separate entity. For accounting purposes, a business organization is a separate entity, distinct not only from its creditors and customers, but also from its owners. It should have its own set of financial records, and its records and reports should refer only to its own affairs. For instance, Flowers Company should have a bank account separate from the account of Anna, the owner. The owner, Anna, may own a home, a car, and other property like assets, and she may have personal debts, but these are not the resources or debts of Flower's company. Anna may own another business, let's say a stationery shop. If she does, she should have a separate set of records for each business. Next slide, we have forms of business organization. The three basic forms of business organization recognized as separate entities are the sole proprietorship, the partnership, and the corporation. The sole proprietorship is the business owned by one person. The owner takes all the profits or losses of business and is liable for all its obligations. Partnership is like a sole proprietorship in most ways, but it has two or more owners. The partners share the profits and losses of the business according to a pre-arranged formula. Generally, any partner can obligate the business to another party, and the personal resources of each partner can be called on to pay the obligation. A partnership must be dissolved if the ownership changes, as when a partner leaves or dies. If the business is to continue as a partnership after this occurs, a new partnership must be formed. So corporation, both the sole proprietorship and partnership are convenient ways of separating the owner's commercial activities from their personal activities. Legally, however, there is no economic separation between the owners and the businesses. A corporation, on the other hand, is a business unit chartered by the state and legally separate from its owners, the stockholders. The stockholders, whose ownership is represented by shares of stock, do not directly control the corporation's operation. Instead, they elect a board of directors to run the corporation for their benefit. In exchange for their limited involvement in the corporation's operation, stockholders enjoy limited liability corporation. That is, their risk of loss is limited to the amount they paid for their shares. Thus, stockholders are often willing to invest in risky but potentially profitable activities. Also, because of stockholders can sell their shares without dissolving the corporation, the life of corporation is unlimited and not subject to the whims or health of a proprietor or a partner. The characteristics of corporation makes them very efficient in amassing capital, which enables them to grow extremely large. So today's our lesson is the end.